The views expressed on this podcast are those of the participants, not of Reuters News.
But I think there is also a kind of a deeper issue, which goes back a little bit to that question of, the question everybody asks, which is what makes this stop? And it's not obvious because, I guess Donald Trump could scrap the entire tariff plan and say, oh, well, forget that. We're going back to some slightly more normal set of policies. But it wouldn't entirely be credible. He's been elected twice under this system. People are going to have in the back of their minds, well, what's to stop him or someone else from coming along and doing something similar in the future?
2 weeks ago, on Liberation Day, US President Donald Trump threw markets into a spin with a barrage of tariffs on global trading partners. As it turned out, that was only the start of the chaos. Levies have since been dialed back on most of the world, massively ramped up to 145% on China, carved out to exclude smartphones, only to eventually, so we are told, be adjusted again with announcements forthcoming on semiconductors, pharmaceuticals, and more. The White House, caught between Trump's bent towards impulsive maximalism and a bevy of CEOs and trading partners begging for relief, faces a trying critic. Investors who have unusually said bond yields spiking and the dollar tumbling. What this all means and what part it could play in determining the course of the trade war is the focus of this week's Viewsroom. Welcome back to the Viewsroom, the weekly podcast that invites you, the listener, into a lively debate with Breakingviews columnists. And I'm your host, Amy Donlan.
And I'm Jonathan Guilford. Amy, it's hard to know how to wrap up the last 2 weeks succinctly. It's been more or less non-stop. I know having conversations with folks who just feel like they're throwing up their hands, analyst notes published in the morning become completely old hat by the afternoon. We've seen Goldman issue and rescind a recession call. We've seen folks just stepping back from the kind of day-to-day. I mean, obviously this has some impact on markets, but just in terms of the overall level of chaos of just following this, I mean, does it feel as totally inscrutable outside the US as it does inside?
I think, it's safe to say yes. And I think, like we had to last week, we must preface all of this conversation with the fact that we are recording on Wednesday and our Viewsroom goes out on Thursday. So as you said about those analyst notes, sometimes when we record, we're hoping that things will stay fresh and still be relevant. But yes, so is the news cycle at the moment. And even those tariffs that we talked about, I mean, who knows if they will still be in place even by the end of tonight. But here anyway to talk to us through this whole situation, we have Peter Tal-Larsen, our global editor of Breakingviews, and Liam Proud, who has been avidly covering the market moves in London. So Peter, Liam, you're very welcome.
Thanks, Amy. Thanks, Jonathan.
Good.
So Liam, if I could start with you, I mean, heading into all of this, I mean, US assets have massively outperformed the rest of the world for years. Treasuries, the dollar, are the bedrock of global capital flows. But all of a sudden now we've got questions arising about the sustainability of both of those, I guess, assets, the dollar and treasuries. How unusual are the moves we're seeing in these markets?
Very unusual is the answer. So, I mean, what you would usually get in a period of market turmoil, maybe it's just useful to start with what you would expect naively and then what actually happened and why that's slightly worrying from a US perspective. You would usually expect that when things are going haywire with global markets, people would rush to the safe haven of the dollar and in particular the US Treasury bond, the 10-year being, sort of the most liquid, most easily sellable financial asset on the planet, off which everything else is priced, basically. So it's called the world's most important funding market for a reason. So you very briefly saw that after April the 2nd, the yields went down, which means the price is going up for a couple of days, which meant people were kind of flooding to the haven of the dollar between that Wednesday, April the 2nd, and that Friday. And then something quite strange started happening on that Friday and over the weekend and on that Monday, where you actually started to see the yields going up, and then they really kept going up And then that following week, last week, between the Monday and the Friday, the 10-year and the 30-year yields went up by kind of 20, 30 basis points, depending on the day, 50 basis points if you take the low for the 10-year and the high. That's like half a percentage point, basically. So from kind of low to high on a daily basis, you got like 4% to 4.5% for the 10-year, which is might not sound big, but it's truly extraordinary. I mean, in particular, I think the move in the 10-year was the biggest weekly move in 20 years. The move in the 30-year between the Monday and the Wednesday, we calculated it as sharper than what happened in March 2020 when people were worried about lockdowns and stuff. So what was going on was people were not buying the safe haven asset, they were selling it. There are several reasons for that. It's probable that people were having to sell whatever they could in order to cover margin calls on losing stock market bets. It's also possible that foreign investors were looking at the kind of slightly, unpredictable and hard to discern policy moves in the US and thinking, do I really want to hold US assets at this point? Kind of too early to tell decisively between those two explanations. But the reason to be worried from a US perspective is, one, the key global financial asset didn't perform its usual function and it moved in quite disorderly ways at times. And two, it happened while the currency was going down, which kind of suggests that people outside of the States were selling. So that's what we've been looking at. And it's kind of slightly less dramatic than it was a few days ago, but the yields are still pretty high and the dollar's still pretty low.
And Peter, can I ask you as well? I mean, I think we both covered the last financial crisis, 2008, which is when you did see these sort of like disorderly moves, as Liam talked about. And not to compare it now to Greece, but I remember one of the things that people talked about was when you see selling at the long end of bonds, that's really when you see like 30-year movements, that is a very disorderly sign. I mean, and also it's a sign of markets that like you would never put the US into that camp. I mean, is that kind of too extreme to be thinking about the US in those ways?
Well, I think, to Liam's point earlier, people sell bonds for good reasons, right? And yields, when you sell a bond, when bond prices go down, yields go up, and that's the market at work. And the market is trying to, in normal times, investors are trying to price in the direction of an economy, what's going to happen to inflation, and so forth. I think what was unusual about what happened with U.S. Treasuries was that everything that had happened in terms of tariffs would point you to a slowdown in the economy, right? The tariffs are effectively a big economic shock and on U.S. consumers, on U.S. companies, and so you would expect this growth to slow as a result of that. There is then you might say, well, tariffs will also push up prices, so there might be a bit of inflation. But all in, you probably would have expected the yield on those bonds to go down, and that's even before you factor in the stuff that Liam was talking about, the sort of the safe haven asset question. So, in order for those yields to go up in that environment, that was really the surprising thing, and again. It's hard to sort of be definitive about these moves in the space of a few days or a week. You have to sort of take a slightly longer term view, and we also have to wait a bit for some of the data in terms of like what's actually happened, in terms of who's been holding these bonds, who's been selling, that kind of stuff. We won't know for sure until later. But I think there's at least a possibility there that you might say, well, people are attaching a risk premium to this supposedly risk-free asset, it is a sort of a feature of emerging markets, right? Is that sometimes you can have a situation where the bond yield is going up, so that the reward for holding those bonds is going up, and at the same time the currency is going down because the reward is not sufficient for foreign investors actually to hold that asset. And we've seen it, it's an emerging market phenomenon. We've seen it during the Eurozone crisis. We saw it in some Eurozone countries. And in the UK, we saw it in 2022 after the infamous Liz Truss budget. Again, you had similar moves. So there is a little bit of a sense of that maybe, given all the sort of the uncertainty that has been unleashed in the past few weeks, that the US capital markets are behaving a little bit more like an emerging market.
Right, and I'm kind of curious about what that means for, I guess, setting the terms of the administration's ability to pursue a trade war, because those flows into Treasury markets are obviously, essential in one sense. Like I think the fiscal deficit in the U.S. widened to $1.3 trillion in the first half of the fiscal year. That needs financing. As Liam was saying, like these base rates feed through to so many markets. Like I don't know, I cover private equity, and obviously like there's a linkage between like Treasury SOFR and ultimately just like corporate credit provision. And I just kind of wondered, like, obviously, when we saw the first pullback in tariff levels from the Trump administration, a lot of the reporting was like, Trump was worried that markets were getting, I believe the word was yippee. And you had, kind of Jamie Dimon on TV, like, urging against this course of action. I mean, what do you think it means for the administration's freedom of action if they just can't achieve what one would assume their ostensible short-term goal is of bringing down yields with kind of fiscal consolidation?
Well, this is back to that emerging market point, right? Which is that governments in emerging markets have been confronted over the years many times with the situation that they're constrained by what the capital market will allow them to do, and by the confidence or lack of it of foreign investors. And I don't want to exaggerate it too much, but there is a little sense of that creeping in here with the Trump administration. As you say, the Trump administration would like to have lower yields because there's a big deficit, and also because they want to cut taxes. So to the extent that the yields stay permanently higher, that there's some sort of risk premium built in, that constrains the administration's ability to do what it wants in terms of fiscal policy. And so, I think that will weigh on the administration's thinking, and that in turn then feeds through. It's potentially a constraint in terms of Trump's tariff policy, because if he's going to do things that are unpredictable and kind of have big economic consequences in terms of putting tariffs on other countries. And there's this sort of feedback loop through the bond markets and through the dollar. He may also have to think that. And there is a bit of calm in the markets now. Things have sort of settled down a bit after the sort of the April 9th U-turn. But I don't think it's settled yet. And I think there is still a lot of uncertainty about where those tariffs are going to end up, and then therefore what that means for the U.S. economy and for the debt markets.
I was kind of curious, Liam, just to bring you in here, because I think, Peter mentioned Liz Truss, and the situation there was that the market reacted terribly. She was then essentially sort of ousted as the prime minister, and there was a complete change in the way that the government was running. I mean, as Peter said, things have calmed down. But even if you could imagine, let's say, Trump rowing back entirely on this tariff plan, do you think that there are any signs in some ways that the damage is done, that actually the yields probably wouldn't go back to the levels that they were at, and the dollar would recover in the way that you'd expect?
Yeah, I think so. I think there's a couple of ways of answering that question. I mean, the thing that people were talking about when it was really kind of going crazy a few days ago was, the only thing that really solved the whole Liz Truss UK gilt crisis was that she resigned and the policy platform was totally, rescinded, and we were back to square one. And obviously that's not going to happen here. So this could just keep going forever. When it actually turned out that it was enough, or so far it seems to have been enough for the market to see that Trump and the administration were sensitive to the market. Essentially, this idea of, there is a trigger somewhere in the data feeds for what's going on with prices for equities and bonds. There's a trigger that would make them think, oh, we've gone too far, we need to back off. So I think people have taken quite a lot of heart from that in the equity market and the bond market. Maybe they're being a bit complacent. We'll have to see. There's a way of measuring that idea of a risk premium remaining. There's this thing called the term premium, which sounds very kind of pointy-headed, but it's essentially, if you own a 10-year bond, rationally, as Peter said, there are reasons for bonds to trade at different levels. In theory, you might think a 10-year bond should be equivalent to owning 10 one-year bonds. So there's an implied expectation for what's going to happen with interest rates over that 10-year period. And if you just take that embedded expectation in markets and then subtract it from what the actual 10-year yield is, then you get this measure called a term premium, which is effectively kind of the same as a risk premium. And that is very elevated at the moment. It's about 0.7, about 70 basis points, according to one model that shows up on my screen. And that's the most in several years. So you say, why is that? Is that because people are attaching a higher kind of policy, uncertainty risk to the US? Do they think, there's a higher chance of debt problems? It's also interesting to see that the credit default swap on US debt, on US 5-year debt, has really ballooned out to levels that you only usually see during kind of government shutdown dramas. So I think you're right. There's a real kind of sense of a scarring on US government debt prices. I mean, it's just worth dwelling on how that fear could be realized, even if the tariff stuff kind of stays as it is. Non-US investors came into this episode extremely overweight US assets, in the sense that they were kind of way more heavily invested in US stocks and US bonds than their ones of their home country or any other nation. And that was largely because they had owned this stuff for a long time and it had done so well. So it had just grown in value to be an outsized portion of the portfolio. So these numbers are so big, like several trillions, like for US fixed income, and tens of trillions for US equities owned by foreigners, that you don't have to assume a massive rebalancing away from the US to get hundreds of billions of implied selling pressure coming onto markets. I think UBS thought that a 5% rebalancing from non-US investors would cause $700 billion of dollar selling pressure, which is 2/3 of the US current account deficit. So the numbers, if you choose to go down that path, are massive. And it's just a question of, at some point we'll know whether that's happening. And right now we don't.
Right, yes. And I think like Apollo's Torsten Slok was pulling some of the relative numbers there, right? And it was kind of eye-opening. It's, I think, overseas investors owning like 30% of treasuries, 20% of US equities, 30% of corporate credit. Like the orders of magnitude are enormous. And that's why I kind of wondered, like, the thing we've been talking around is really like whether those like big, like in the treasury market, big reserve buyers really are like, there are signs of them pulling back, because that's kind of like the bogeyman that's always hung over like discourse around the treasury market. Like, oh, what happens if Japan, becomes like a net seller, or China becomes, or if there's, something that really begins to affect kind of like international capital flows, especially in a moment where there's all this narrative around like infrastructure spending and like big, heavy like capex that needs to like kind of pour into the US, and like a lot of that routes through private equity funds where, Canada, Saudi Arabia, etc., are like some of the biggest allocators. Like, I wonder if there are, kind of like real sort of like technical science, because I know as we've sort of been pacing through here, there were a ton of theories floating around about why treasuries moved in the way they did, whether it was like over-leveraged hedge funds unwinding, or whether it was this kind of like reserve buyers like beginning to go on strike. Like, do you think there is like an actual solid sign of which gun fired there?
I think you have to distinguish between reserve buyers and foreign investors. I think like you don't have to involve the foreign exchange reserves of government-linked entities really here. I think they move very slowly, and they largely hold short-term stuff, and it's short-term old stuff, what you call off the run. And you haven't seen that much price action in those markets. And you don't need to, right? There's enough money in the Australian pension system, in the Dutch pension system, in Japanese insurers. That's where, a huge amount of this rebalancing is like just actively managed private sector money. Maybe you would get the official money moving at some point much further down the line, and then you get to even kind of bigger numbers. But I don't think you need to invoke that in order to get the scary notions that we've been talking about.
But there are some, there are some big factors here, and I think sort of two things really to consider. One is to Liam's point. People were massively overweight the US. This was something that came up at the end of last year a lot. We wrote a bit of stuff about it. That you talk to big pension funds, and they were really sort of worried about the fact that they were so that the US stock market alone was such a big chunk of the capitalization of global markets, and that they were worried about that exposure and the lack of diversification that implied. But on the flip side, if you didn't own it, then you underperformed. The rest of the world was underperforming. So how did you juggle those things? So part of it is just U.S. assets have done so well, people have a lot of exposure to them, and so even you just have a bit of an adjustment there. It makes a big difference. But I think there is also a kind of a deeper issue, which goes back a little bit to that question of, the question everybody asks, which is what makes this stop, and it's not obvious because I guess Donald Trump could scrap the entire tariff plan and say, oh well, forget that, we're going back to some slightly more normal set of policies, but it wouldn't entirely be credible. He's been elected twice under this system. People are going to have in the back of their minds, well, what's to stop him or someone else from coming along and doing something similar in the future? And this is a real issue for the US because the US has these famous twin deficits, right? It has, on the one hand, it has a big fiscal deficit, which is very large. Even though the economy has been growing, it's been borrowing 5, 6, 7% of GDP every year, and that then piles onto the debt, which has to be financed. And at the same time, obviously, has a current account deficit, so it is importing more than it exports, which again that has to be financed by overseas investors. So the US is very dependent on the famous phrase, the phrase that Mark Carney, then the governor of the Bank of England, now the Prime Minister of Canada, sort of called the kindness of strangers. Right, he was talking about the UK. Basically, the UK was dependent on which has a similar funding structure, was dependent on the kindness of strangers. The US is in a similar position, and in that context, if you have an administration that is saber rattling with its allies and threatening to annex Greenland and make Canada the 51st state, and thumbing its nose at traditional allies in Europe and stuff, well, those strangers might decide to be a bit less kind, and and that could have a real impact. So I think that at a sort of fundamental level is the thing that may have changed in the last 2 weeks, and that could have a really big ongoing impact on the US economy, financial markets, and by implication the whole world.
Which kind of takes you to the currency, right? So there's an argument in certain circles about whether the US benefits or suffers from the dollar's status as a world reserve currency. So I guess I'm looking for Peter, you and Liam. Is there a way to think through what the weakening of that status means to the US?
Look, I mean, this is a perennial discussion, and I think we have to be a bit careful about declaring the end of the dollar as a reserve currency, because the dollar has been through many bumps and crises along the way. I mean, if you even in the sort of the post World War II period, think about it survived Richard Nixon closing the gold window. It survived devaluation, inflation, war, other kinds of upheaval, and each time people said, this is it for the dollar. Now this is the point. The yen or the renminbi or the euro is really going to take over, or cryptocurrencies, and it hasn't happened. So it's pretty resilient, that. But I do think we are once again facing these questions in quite an existential way. You do come back to that. There's an internal factor and an external factor, and the internal factor is definitely the US has behaved in ways that are not necessarily consistent with being an issuer of a reserve currency. And the Fed is still independent, so as long as that holds, it might be okay. But if Trump were to mess with that, it could get really hairy. But there is also an external factor, which is what is the alternative? And we and others have looked at this in great detail, and it's still not really obvious. The euro is probably the next best contender, but it's a bit of a hybrid currency. It doesn't have the backing of a single government, or so there's always question marks over the euro. The yen, Japan has its own issues in terms of debt. Sterling, we all know about. The Chinese yuan is, it's got capital controls and so forth. But the lack of an alternative is still quite quite pressing, and that means that even some of these big reserve managers that Liam were talking about, who may be sitting there thinking we really need to rethink our exposure to dollars, then have to answer the question of like, what do we rebalance it to? And okay, you can buy some gold, but that's about it at the moment.
Yeah, I think that's right. I mean, as it's less on the dollar and just more on the Treasury as the world's kind of safe haven. I think it's just worth bearing in mind that there have been repeated episodes now of quite surprising dislocations in what is supposed to be the world's most liquid asset. So you saw in March 2020 similar dynamic where the yield went up, i.e. the price went down in a moment where you'd expect people would be rushing to the safety of the US Treasury. And then you've obviously had this episode, and then you've had kind of structurally similar episodes. And the thing that worries financial stability watchers about this is that perhaps the actual incidence of why it happened what triggered it is less important than the kind of structural dynamics that are allowing this to keep happening. And those dynamics would be, after the financial crisis, we sort of put very, from the bank's perspective, onerous capital requirements on trading activities. So you can't have Bank of America and JP Morgan stepping in and just scooping up all these treasuries when people lose their minds and saying, you know what, this is going to be all over in a few days. We'll just hold on to this for a bit and then release them back into market, acting as an intermediator to smooth out things. They feel like they're constrained by capital requirements from doing that. And then on the other side, you've seen extremely highly leveraged hedge funds effectively become the marginal incremental buyer and seller, the swing vote, if you like, in terms of setting the prices and intermediating these markets indirectly. And those players, the story goes, are much more sensitive to sudden swings in confidence and sudden swings in market funding than banks, who in theory have locked up funding and government kind of protection. So there are options on the table for solving that, but it's definitely a live discussion, and you hear ideas do the rounds about, well, should you open up emergency lending facilities for hedge funds? It sounds kind of very counterintuitive, but some pretty serious people have been talking about that. The Bank of England is doing that for insurers and pensions funds. It's historically only done that for banks. And other ideas would be, this is the one the banks would favour, just let us do whatever we want with treasuries. Don't count them towards capital requirements. We'll just don't worry, we'll do it safely. So I think that plays into this story of US centrality in the global financial world, is some pretty deep structural vulnerabilities in the treasury market.
It's so interesting to be talking about all this kind of like out on the frontier policy response stuff in response to a completely unnecessary policy change, as opposed to like any exogenous factor. It's so fascinating as a moment for markets. But like, that's a great place to wrap it up. Peter, Liam, thank you so much for joining us on the Viewsroom.
Thanks.
Thanks, guys.